Hello everyone, welcome back to my channel. Today I will explain one of the most accounting topics, the ledger account. This video is especially made for new learners, students and beginners. After watching this video, you will clearly understand about ledger account. So let's start. From this video, we will learn today what ledger and ledger account. What does general ledger include? 5 key of general ledger account. Why ledger account is important. Relationship between journal and ledger. General ledger format. Debit and credit rules. Posting from journal with practical example. What is a ledger? A ledger is a book where all accounts of a business are recorded separately. Journal records transaction date-wise and ledger records transaction account-wise. So, ledger is also called the principal book of accounts. What is a ledger account? An accounting ledger is a part of the bookkeeping system and is used by business to record all their financial transactions. Business will create separate categories for such transactions, which are known as accounts. All account records of a company will be listed and contained within the general ledger or principal book of accounts. A ledger account is a separate account prepared in the ledger for cash, capital, purchase, sales, expenses, income, assets, liabilities. 5 key of general ledger account. The general ledger must include all accounts of a business that will appear on their financial statement at the end of an accounting period. These are known as general ledger account or GL accounts. The 5 key types of GL account are assets, liabilities, equity, revenue or income, and expenses. Why ledger account is important? Ledger account is important for it shows individual account position, helps to find balance of each account, basis of trial balance, helps to prepare income and expenses or profit and loss, balance sheet. Without ledger, financial statements are impossible. For that, ledger account is important. Relationship between journal and ledger. Journal is the first book of entry and ledger is the second stage of entry. Journal records all transactions and ledger classifies the transactions. Journal transaction is date-wise and ledger transaction is account-wise. Journal has no balance but ledger shows balance. At first, financial transaction entry into journal, then journal to ledger, ledger to trial balance, and finally trial balance to final accounts. What does a general ledger include? A general ledger has 4 primary components. These include a journal entry, a description, debit and credit columns, and a balance. A journal entry, the number of each journal entry posted to the account and the date of the entry. Description: a description of the transactions, debit and credit columns. Each journal entry posts a debit or credit to the general ledger. A balance: a general ledger lists the account balance each time a debit or credit post to the account. At month ends, after all journal entries post, the ending balance is calculated. Format of general ledger account. In general ledger format, at first, the name of the company, company address, which period we prepare general ledger. This is account head. Then format has date column, description or particulars, reference, folio or page number, debit amount, credit amount, and net balance amount. Then total amount and net difference balance from debit to credit. Now, golden rules of accounts. In accounting has three golden rules. One is personal account, second real account, and third is nominal account. In personal account, debit the receiver, credit the giver, real account, debit what comes in and credit what goes out. Nominal account, debit all expense and losses and credit will be all income and gain. These rules decide which side of ledger the amount goes. This is the practical example of transactions. From this transaction, we posted it journal and ledger account. In my previous video, I explained by this example how prepare journal entry. You can see this video. First transaction, 1st January 2026, Mr. X started business with cash 50,000. Journal entry is cash account debit 50,000 taka to Mr. X capital account credit 50,000 taka. Because Mr. X started business with cash, here cash is increased, so cash account debit 50,000 taka and capital is increased, that is liability of the company to Mr. X, so capital account credit 50,000 taka. Here we can see two ledger account, one is cash account and another is capital account. Cash account ledger and capital account ledger. Cash increase, that is debit, cash account ledger to capital account debit 50,000 taka. And capital account ledger liability increase, capital account credit taka 50,000 by cash credit 50,000. Second entry, 1st January 2026, purchased furniture for cash taka 10,000. Transaction will be furniture account debit 10,000 to cash account credit 10,000. Here furniture purchase, so asset increase, furniture account debit 10,000, paid by cash 10,000, asset decrease, so cash account credit 10,000. So to cash account credit 10,000. Here two ledger account, one is furniture account and another is cash account. Furniture account and cash account. Furniture increase 10,000 debit. To cash account debit 10,000. And cash decrease 10,000. So cash account buy furniture, cash decrease 10,000 in credit column. Next entry, 2nd January 2026, paid rent 3,000 taka. Journal entry will be rent account debit 3,000 to cash account credit 3,000. Because expense increase, rent paid, so rent account debit 3,000 and cash decrease, so cash account credit 3,000. Here two ledger account, one is rent account and another is cash account. This is rent account and cash account. Expense increase, rent paid by cash, so rent account ledger will be cash account debit 3,000 taka and cash decrease, that is asset decrease by rent paid, so cash account ledger will be rent account credit 3,000 taka. Last transaction is 2nd January 2026, sold goods for cash taka 50,000. Journal entry will be cash account debit taka 15,000 to sales account credit taka 15,000. Here cash increase taka 15,000 by sold goods, so cash account debit, and revenue increase by selling goods, so sales account credit taka 15,000. Here two ledger account, one is cash account and another is sale account. This is sale account and this is cash account. In cash account, cash increase, that is asset increase, so cash account ledger will be debit taka 15,000 to sales account, and sales account, that is revenue increase by selling goods, so sales account ledger will be cash account credit taka 15,000. Now we will calculate the balancing figure of every ledger account. At first, cash account, 1st January, debit 15,000, credit nil, so balance 50,000. Second transaction by furniture account, credit 10,000, so net balance will be 50,000 minus 10,000 equal to 40,000. By rent account, credit 3,000 minus 40 to 3,000, balance 37,000. To sales account, debit 50,000, cash increase, so 37,000 plus 15,000 equal to 52,000. Cash account balancing figure is 52,000. This 52,000 will be debit side balance because debit balance is greater than credit balance. In capital account, no debit balance, only credit balance 50,000, so net balance 50,000. This is credit side balance. In furniture account, debit balance 10,000, credit balance nil, so net balance 10,000. This is debit side balance. In rent account, debit side is 3,000 balance, credit side no balance, so net balance is 3,000. This is debit balance. In sales account, debit side nil, credit balance 50,000, net balance 50,000. This net balance will be credit balance 15,000. So viewers, these are the all of general ledger account. I hope this video helped you understand the topic clearly. If this video helped you, please like, share and subscribe. Thank you for watching.